real estate as back to this liquidity issue, you're trading liquidity for returns. And that's how it should be looked at in a vacuum, is saying, if you're going to have my money tied up for 2 years, 3 years, 4 years, first of all, I don't like money to be tied up longer than 3 or 4 years, because since I'm not making money on the front end, I'm not running a charity. I'd like to actually build these, sell them, and get paid myself. So back to that kind of alignment of interests, like we're sitting on the same side of the table. But with that said, on a 3-4 year run in the markets that we have with the macroeconomic indicators, what's happening in Texas and these other growing Sunbelt cities, you should be looking at a multiple on equity. Are we flippers? No. Are you getting it in 6 months to create some, short-term capital gains tax? Absolutely not. But on the 2 to 3, 4 year range, if you're beating benchmarks, looking to double your money, and again, nothing's guaranteed. You go get hit by a bus, right? But the expectation and what we are looking to do on a gross basis is to at least double the equity every 3 to 4 years. And if we can double it in the 4 years, you make your split, we make our split, everybody's happy. Does it happen like that always? No. Sometimes it's more, sometimes it's less. But that's why I always encourage people to do multiple investments. And even in looking at funds, with a lot of time get a bad rap, but a fund in the correct structure is an impeccable design because it is inherent diversity. So if something sells earlier, something goes down, something goes up, we're not cycles. I mean, Forbes called me the Oracle of Austin, which is looking like we're pretty psychic, but I just believe, we can read the numbers better. I just think we understand the data, better than a lot of other folks are. But I'm sure it's certainly an expectation that I'm comfortable with, knowing the disclosures and knowing that things can happen on a 3 to 4 year basis, getting all your money back and looking at a multiple. I think that's absolutely within what our track record has shown, exiting over 60 buildings over the past, close to a decade. That those numbers are to be expected. And if you don't feel that you're going to be making returns like that with a good downside protection, as I've told you before, my first objective is always don't lose money. Making money will always be secondary to me, but I feel like if you understand the downside properly, it increases the probability of making money on the back end. I think the most important thing about alignment of interests is seeing the skin that your manager has in the game. I think that's the question. Whether you do business with us or do business with anybody else, what I want to know as an investor, are you invested in this deal with me? Like, do you have money in it? Do your kids have money in it? Like, are you just being rewarded for capital raising? So if you tell me a great story, which is part of the dog and pony show, it's okay. You have to share people with what the vision is, but are you doing that with an element of salesmanship that supersedes the value? And by eliminating those discussion points and really saying that we make money when you make money after your money is returned, I think that ends the discussion.